All right, everybody. C. Ray Brower here today with John King on Your Perfect Home video podcast, and we are going to be coming up next. Hey, John, we are back. How's it going?
Amazing, C. Ray. How are you?
Really, really good. It's been an exciting week so far.
Got it. Well, I can attest to just a lot of excitement going on in life and the mortgage and real estate industry, and I think we're all kind of getting. I don't know about you, but I'm getting my fill of excitement. I'd love a little bit of boring. I'd love a little bit of status quo. How about you, C. Ray?
Status quo would be good, but what is actually status quo when you look at it?
I have absolutely no idea, and I wish that there was something that could be defined as, hey, this is normal. But you're right, like normal is change, and I think that's the key that we all have to understand to make it through this crazy thing we call life.
Well, we know that the only normal is change.
That is true. It's the only thing you can expect is change on a daily basis, and if you embrace it, you're good. If you fight it, you're in trouble.
Yep, there you go. So what is happening in the mortgage world right now? Everybody gets a gloom and doom, and then it's going to be good, and then it's back to gloom and doom.
I think they're all right. I think everybody is accurate. It's a perspective issue right now. I think, look, it's what's your status quo, right? What's your norm? Is doom and gloom something that is because we're not where rates were back in 2020? Well, you know what? It's the truth is that was unhealthy in and of itself. I mean, you had house prices just skyrocketing so quickly, and that's not good. And then we have inflation and we have interest rates that are skyrocketing quickly, and well, that's not good. And I think it really creates a lot of uncertainty. The biggest challenge right now, and I've been, just kind of looking at where society is and where people's mindsets are. And I got to tell you, C. Ray, the thing that concerns me is how much people's debt has exploded over the last couple of years. Have you tuned into that or paid attention to that at all? C. Ray, have you seen any of the numbers or taken a look at kind of what's happening with people's credit card debt and just how bad the debt circumstances are becoming in America right now?
Yeah, no, it's crazy right now. People are trying to adapt to this crazy inflation that's happened to us, and of course our wages didn't increase. For many of us, it decreased because there's not as much to do. So, but then you turn around and you have Hollywood striking. The restaurant workers down in the LA area are all striking. It was official at 4 a.m. this morning. Was down there at the first of the month, helping my daughter and son-in-law move down there. And on the third, they were supposed to be on strike, but son-in-law said that was just kind of a preliminary strike. I asked him if they was seeing if they was strong enough to hold the signs.
So it's the strike before the strike? Is that what they're saying?
What's that?
The strike before the strike, the preliminary strike?
Right, the preliminary strike, the practice strike.
Yeah, we'll make sure we get it right kind of strike. Well, I will tell you, anecdotally, I've had 4 clients in the last 60 days that have come to me saying, John, my credit card debt has ballooned, and it's a death spiral that they're looking. I mean, across the board, a year ago, the average credit card interest rate was 18 to 22%. And then the Fed raises interest rates by 5%. And now those are looking at 23 to 29% interest. Everything becomes more expensive. We all think I'll fix it tomorrow. And I'm not, I mean, we all have that challenge of, hey, I've got to pay for my kids' braces. I've got to pay for school. There's splurging, and then there's just life. And
Yeah.
things have changed so quickly in the last 2 years that I'm getting actually scared for a lot of people, and just where are they at with their debt? And for too many people, they're sticking their head in the sand and they're saying, I hope it gets better. I'm sure it'll get better tomorrow. And tomorrow doesn't come. And then they start robbing Peter to pay Paul and pulling money from here to cover that. And hey, let's take a cash advance on the credit card just this once because it's important. And I get it. Like I'm not judging by any means.
Yeah.
I'm nervous. I'm nervous for what does that mean when people really sit down. I had a client that we went through the numbers and she said, hey, John, I don't know what to do. And I said, well, let's talk about what your options are. And the good news is they've lived in their home for quite some time. And even people who bought a home in 2020, you got a lot of equity right now that you didn't have a couple of years ago.
Yeah.
But she said, John, I've got a 2.9% interest rate, and rates right now are at 7%. So refinancing isn't an option. Well, the truth is we ran the numbers with the refinance, and it saved her $1,400 a month off of her monthly payments.
Really?
That if she simply took that same money and put it back into the mortgage payments, she'd be completely debt-free in 12 years. So everybody says, I don't want to refinance at a 7% interest rate when I have a 3% rate. But you're spending so much money in those credit card bills and the interest you're paying on it. I don't want you to extend your credit card bills for 30 years. I want you to take all that money you're throwing away in credit card interest and transfer that payment to a mortgage payment. And that way you pay off significantly faster. That I told my client, she goes, great, then let's do it as a 15-year loan. And I said, that's not a bad idea. But what if something changes? What if rates go to 9% and your job cuts you back a little bit, inflation gets even worse, and now you got to start using the credit cards again because you just saddled yourself with a mandatory payment at that high level? I suggest we put you at a 30-year payment and you throw the extra at that debt. And it gives her a cushion of $1,400 she could fall back on if things get tough, instead of charging a credit card if things get tough.
Right.
It's just that time right now where people have so much debt that thinking outside the box, instead of saying, hey, I'll go get a home equity line of credit, that was great a year ago. A year ago, I told every one of my clients, do not refinance your mortgage, go get a home equity line of credit. I think by summer of 23, spring of 23, rates will be coming back down. I thought wrong. I'm right here telling you my best guess was just that. It was a guess, an educated guess, but
Educated, but
it's no different than the weatherman trying to predict if it's going to be, sunny or rainy tomorrow. It's an educated guess. But I'll tell you that my mindset's changed because a lot of those home equity loans and lines of credit, they're pushing double digits for a lot of people. Like they were at 4% 2 years ago. The Fed's raised rates significantly. They're at 5.5% rate increase, which means that 4% rate's gone to 9.5%.
Yep.
So
I know several people right now that are doing that. Yep.
And it was a smart thing to do. It was absolutely the smartest option, and you kept your low interest rate mortgage. But we're getting to that point right now where you got to change your mindset of what's smart. You got to reevaluate. Doesn't mean I'm not advocating that everybody should pull cash out of their home, but the truth is the truth. What you owe is what you owe. And taking a smart look at the last few years and what it did for everybody is it gave us a huge amount of equity. And as I said, a year ago, I would have said tap into it through a line of credit or through a home equity loan. Today, my advice is always case by case and client specific, but generally speaking, cash out, even if you're raising a rate to 7, is making sense more often than taking out a second mortgage.
Right. Right.
So it's definitely a pivot in some of the things that I've been talking about, some of the thoughts and advice that I've been giving to my clients, and obviously I try and do the same to your viewers as we sit in this podcast, is we've got to change the way that we're thinking, because this is not ending as soon as we had hoped. And I think we have another 9 to 12 months of a high rate environment. The Fed's made it clear. They're intending, they're gonna be meeting next week, so we'll see. But they're intending on raising rates still a couple of times before the end of the year. And that means they're not gonna start lowering them. And although the Fed doesn't control mortgage rates, they influence them. And so mortgage rates rarely move the opposite direction of where the Fed is going. So
Right.
I think we're looking at spring, summer of next year before we start seeing some relief. And in the meantime, I've got people that are at the tipping point that are about to not be able to make their credit card payments, and now they're going to have late payments, and their credit's going to get impacted, and it becomes a spiral. It becomes a challenge that you almost can't dig yourself out of the hole, because you're financially stubborn, thinking that super low interest rate's more important than anything else. And the truth is, it's very important. And if you can keep that low rate, do it. But not at the sake of risking your credit, not at the sake of risking, not being able to pay your bills or not being able to feed your family. I mean, I don't mean to be dramatic. I can be really dramatic if you want me to, see, right? But I just think that it's a conversation that I'm having with a lot of my clients right now of just, hey, do you mind if I'm real with you? I'm worried about a lot of people and what's happened with their credit card debt.
Right.
How are you doing with yours? And it's a tough conversation, but I kind of feel like for a lot of my clients, I'm the closest they're ever going to get to a financial advisor. I am not a financial advisor.
Right.
But I think that I have an obligation to help people open their eyes to, hey, this isn't the only way. And let's look at other options that we can help you head it off at the pass before it becomes a bigger problem that you can't manage.
Yeah, very, very true. It's hard for people to take that step and look at that higher interest rate. But it's like I was telling somebody just the other day when I was talking about the high interest rate, and I said, I've only been doing this for 8 years, but the interest rate was pretty close to this 8 years ago.
Mm-hmm.
Now, yes, the house prices are higher now because 8 years ago we had just got back to where the bubble burst took us down and back up, and we were at the point when I got in where we were actually at the exact same point in appreciation of homes had we not had the bubble burst. Then we had the coronavirus, it shut us down, and we had some unicorn years of extremely high appreciation, which turned around now and they've cut off many things, and they're changing everything in our world as fast as they possibly can. And it's led to some crazy inflation that, yes, we have to curb that 15%, 20% appreciation per year of a home and get it back to a normal 3 to 5, 6% on a really good year appreciation on the homes. And then we can all kind of get back to the normal if people can get their wages up to where they need to be to take care of this crazy inflation that we've been through.
Well, and I think that the reason why we're seeing a lot of inflation stay persistent in this cycle is because for the first time in history, we have a majority of the homeowner population with a huge amount of discretionary income, even in a high inflation environment. Now, how can that be? Because they have a 2.5% interest rate. And they bought their house in 2012 when the market was low. And they're in a position where we've gotten pay raises over the last 10 years, even though the cost of owning a home hasn't really gone up. Like prices went up, but rates were going down. And so the cost of owning a home stayed the same. Wages kept going up. And so we have a built-in buffer for all of these homeowners that have owned their home for a period of time that says, yeah, I know that it's more expensive to buy eggs and bread and meat and everything else, but the truth is my house payment's pretty low. I'm spoiled. I'm paying $1,200 a month for a house that would rent right now for $3,000.
Yeah.
It's the renters and the new home buyers that are struggling the most. And it's a catch-22 because if you're a homeowner, you're on the other side of that divide and you're enjoying the benefits of home ownership. Allows you to have a fixed housing expense that goes down over time. Rent is the opposite, it goes up. But you got to be able to leap over that divide. You have to be able to get from being a renter to being a homeowner. And the challenge is the difference today between rent and a house payment. You're paying a lot more to get into a house. And so that's where I'm happy to have lots of tools to help people with kind of how do you get on the ship? How do you get onto the boat of home ownership? And one of the new ones we just came out with is called Golden Opportunities. And it's a really, really great program because it stretches the box just a little bit for the people that were near misses. The people who couldn't get to the 640 credit score. They made it to 620, but they couldn't get right there to 640. This new program lets people with a 620 credit score get a really attractive down payment assistance program. It also lets people stretch their debt to income ratio a little bit further, spend more. Now you're gonna, if your audience is paying attention, they're gonna say, John, that's a bad thing. Like you don't want to, in an inflationary environment, have people stretching their debt to income ratio. And I agree. But there's a lot of people who rent that can't buy because they can't prove all of their income. Maybe you've got a second job that you haven't had for 2 years. Maybe you have a roommate that lives with you that helps you pay for your housing expenses, but I can't count that income. I can't count that income. So you might make $65,000 a year, but the truth is you have $90,000 a year of actual income to make the mortgage payment.
Right.
But you can't prove the 90, you can only prove the 65. It's for those people that these golden opportunities are available now to stretch their dollars, not to put them in a place that they're not comfortable. And I'm going to dive into that word comfortable in a minute, but I don't want to stretch them to where they're not comfortable and that they're going to fail. But we're preventing a bunch of people from getting over that divide into home ownership because we can't prove all of the income. And so this opens up that avenue of helping those people deal with those challenges.
Very, very nice. Very, very nice. Now, how far does it stretch that DTI, debt to income ratio?
So this program will let us go to 55% debt to income ratio, which a normal FHA loan will let us do, but none of the down payment assistance loans would. So if you had your own money for down payment for your 3.5% down, FHA will let us spend 55% of your income towards your total bills. But when you needed down payment assistance, you were usually limited to 45% of your income towards all of your debts. So this puts it back in line with what FHA will allow, even for people who are using down payment assistance. So it really opens up that opportunity for those people that are near misses. We're We're not taking somebody that's far away from qualifying. We're taking that person that we just couldn't make it. How
Just
do we push them
really,
over the
really
edge?
close. Yeah.
Yep. Yep.
Very, very nice. And, I mean, FHA's worked for a lot of people for a lot of years. So why can't we do it when
Yeah.
they're getting some assistance, right?
I completely agree. But I'll transition real quick to one more thing, C. Ray, which is the comment that I made about comfortable with your monthly payment. I had another client that I talked to yesterday who makes good money, and they're well into six-figure income, and they were very conservative about what they wanted to spend for a house payment. And as I talked to them and we talked about where their comfort level was, and they said, "Oh, my comfort level is way down here. I don't want to buy more than a $375,000 to $400,000 home." And I said, "Okay, by my math, you could buy a $700,000 home. Now, I don't want you to have that payment, but I'd let you. So what I'm wondering is, where's that money going?" And there's two places the money's going. It's going to pay for stuff, or it's going into savings. You're either spending it or you're saving it. Well, in their case, they were saving it. They were putting a bunch of money into their retirement account. They were putting a bunch of money into a savings account every single month. And when they ran their numbers to buy a home, they didn't want to change how much money they were saving. I was super proud of them. I was super happy with that mindset. But I went on to explain to them, gang, the math doesn't add up. There aren't homes out there that are what you want at that payment. So what if we just switch where you're investing your money? Instead of putting $1,000 a month into your high yield savings account, cut it down to $250 a month. Because owning a home is a savings account. It's money that you're going to get later because of appreciation, but also because every payment you make, part of that payment pays down your balance. So it's kind of like a forced savings account. And that's something that they hadn't thought about. And now I said, look, I don't want you to go splurge on a $700,000 home.
Right.
But it's important to understand, to get a house that will fit your family, you're going to have to spend more than you were comfortable spending. But that's the key. I'm happy to help people see, hey, you've got to stretch your comfort level because you can't get a comfortable payment today. But either if you qualify with enough income, you just don't have it left over, you got to figure out where you're throwing it away. Where are you spending that you can cut back, which is a whole different story. Or in the case with this client, it was, well, good, let's just switch from one investment to another. It's like buying stock in Tesla versus buying stock in Ford. You're just investing in something else. You're still investing every single month.
Absolutely, every single month. And a lot of people don't look at that and realize the wide gap in the actual value, the actual, go ahead, tell me the word, I can't say it. Net worth.
Yeah, net worth.
Net worth between a renter and a homeowner. And it's not just a little bit. It's not just, it's huge. It's huge. And people do not realize that, haven't been taught that. Part of the problem with our system is they don't teach this stuff. It has to come from outside, and oftentimes people that are looking at you and me and anybody else that's selling something, they're thinking that we're just trying to fill our pocket and take something away from them, that when really what we're trying to do is help them. And I think we both have a way of conveying that to people without feeling sleazy or greasy, or that we are trying to take things away from somebody. It's a conversation of, this is what you're doing and this is what you could be doing, and if you do this, you'll be this much better off in the future. Yes, it'll be tough today, thinking of the fact that you're not going to put that whole $1,000 in, you're only going to put 250, but the 750 that you're putting into your house is actually, in most cases, going to give you a better return than what it was in that savings account.
Siri, what you're getting at is the term, and I know you know this term well, but I'll identify it, and it's called leverage. Because that money, that $750 that you were going to put into a savings account, even if it grew by 20%, it's still only $150 that it grew. Versus if that $750 lets you buy an extra $100,000 home. Now that $100,000 home, if it grows by only 5%, you've still made $5,000 on that by spending $750. So it's leverage. It's a game changer. And that's the key when it comes to wealth building. And to me, that's phase 2. People have a hard time understanding and visualizing that. And I've tried to use that as a story to explain the value of home ownership. But that's a tough one for a lot of people to really get their head around. Yeah. And really at this point, it's more important to focus on, hey, right now you're going to jump up in your monthly payment on your rent compared to your rent, but it's going to stay there and you can actually lower it as rates come down. So right now it's about taking that investment today so that sooner or later that rent's going to keep going up and it's going to surpass what that mortgage payment is. That's the moment when it all makes sense. When the work you did to become a homeowner, the extra money you spent every month, it's like, oh, wait, I'm now ahead of the game. And then you realize I've also got all these benefits of leverage and of well, I have equity in my home that I could use. And I'm always cautious how you use equity in your home. But the truth is it's an asset. And done wisely, you can use that asset to buy other assets. And there's lots of things that you can do, but you can't talk about any of those until we get started. And that's really the conversation I'm having with people a lot right now.
Yeah. You do have to step forward and get started. No matter what it is, staying in one place is never really going to get you anywhere because, again, like you said, rent's going to keep going up. Now, there's people that are fortunate enough that they had a landlord that never raised their rent for 4 years, 5 years, 8 years, 10 years. They've just never raised the rent. But sooner or later, they're going to get that big hit that, today they're only paying $1,200 a month, and it's going to cost them $1,900 a month to buy a house. And I want to stay and only pay $1,200 a month. But in 2 years, when that landlord decides he's going to liquidate his asset and go ahead and sell it to somebody that's going to now want market rent, and now that payment is $3,000 a month instead of $1,200 or $1,400 a month, whatever they've been stuck at for all these years, because a lot of landlords don't want to rock the boat.
Right.
And cause a tenant to leave because the rent's going up. But the rent's going up everywhere. They're not gonna go find a cheaper place than what they're in.
That's right.
Other than stay there and make the landlord rich.
That's right. You're paying somebody's mortgage, whether it's yours or your landlord's.
Yep, exactly.
I agree, my
well,
friend.
John, it's been a great conversation, but we are at the end of our time. Everybody, John Lone King with Summit Funding. If you need anything, you want to go ahead and give them all your contact information, even though it's been scrolling down below.
Floating right across the bottom, so you can call me, 209-366-5353, or reach out to me via email, john@johnloneking.com. But the best thing that you can do, find me on YouTube. I've got a YouTube channel with a lot of what I think is great content, and it's the same John Lone King. So search at John Lone King on YouTube. I would love for you to check out my videos on there, and I'd be honored if you'd subscribe.
and he does have some great stuff on there. I really appreciate working with people like you, John. Thank you so much. Everybody, remember C-Ray to find your perfect home. Like, click, and share. Sharing is caring. So I love you all. Thank you so much for stopping by, and go out and be the sunshine in somebody's rainy day.